I'm going to show you how I put together an investing portfolio this year. And let me first just say that it's easier than you might think, and many people like to make this way too complicated. I'm going to run through what kinds of things you can invest in, what you need to consider, and I'll also share my own views on how I invest my money. And let me just say that I think I've changed my mind on a few things over the years that I've been investing, but we'll touch on those things a bit later. Anyway, first off, what do we mean when we say an investing portfolio? Really, it's just a group of things that we invest in and that we hope will go up in value over the long term. So that could be anything from buying shares in companies, buying bonds, buying property, or even things like cryptocurrency and gold. Now, the hard part is trying to work out how much you need to buy of each one, because if you get this part wrong, you could end up costing yourself a lot of money in the long run. So here's where things get interesting and potentially very complicated if you listen to some people who will convince you that you need to invest in a dozen different things to make a proper portfolio. Now, a lot of this will depend on what you want as an investor and what your goals are. If you're able to invest for the long run and you're trying to build your wealth, then your portfolio is going to look very different from someone else who might be retired or about to retire. A lot of this comes down to trying to balance the risks and rewards of all the different things you can invest in. In this video, I'm really focused more on the people who want to build their wealth over the long term, as a portfolio in retirement has a few different things to consider. Anyway, let me show you something which explains this a little better. On screen now is a heat map showing what type of asset gave you the most profit each year for the last 10 years. The green boxes are for company stocks, the yellow ones are for bonds, and then the orange boxes are for other investments like real estate and commodities. As you can see, if you take any year on its own, basically anything can happen. Take 2018 as an example. It was actually a pretty bad year for all stocks, and the best performing thing to hold was actually short-term bonds, which are also referred to as cash. Now, can you imagine, if you looked at this year and wanted to start investing, you might think twice about buying any kinds of stocks, and you may have just said, you're going to buy bonds because they perform the best, so they'll probably do well in the next year as well too, right? Well, if you'd done that, you would have made a very bad decision, as look what happened in 2019. Pretty much a complete 180, and US stocks were back up on top with a gain of over 30%, and cash was all the way at the bottom of the pile. Now, the same investor is probably thinking, better go all in on US stocks then, and you should probably do pretty well. But then you'll see even in the next year, Chinese stocks actually did the best. Basically, anything can happen in any year, but if you flip on your long-term cap and forget about the short term, you do start to get a few patterns showing up. So if you focus here on this column on the right, you get the longer term averages, and you'll start to see that generally stocks do better in the long run and things like bonds aren't so good. We can also use a super long-term chart which shows this even better too. If I bring up this one here, we get an even better picture of what we might be able to expect. Here's more than 200 years of data following all the different types of things we can invest in. And this one clearly shows that investing in stocks has beaten everything else like bonds and gold. Also, this is adjusting for inflation too, just in case you were wondering. So this is a real return and not just a nominal one. That's always important to remember, as unless you beat inflation over the long run, you can actually lose buying power with your money. Investing in anything really just boils down to that one key factor. How much can you beat inflation by to stop your money losing value over the long run? Just quickly on that point about inflation, remember that if one of your investments goes up by 10% in a year, but inflation was 6%, then your real rate of return is actually 4%. It's still a profit, but you always have to take inflation into account with anything you decide to invest in. Okay, so just go all in on stocks for the long run and you're guaranteed to make money and your investing portfolio is complete? Well, not so fast, I'd say. The biggest question next would be, well, what stocks do you invest in, and how are you meant to know which companies will do well over the next 10, 20 or 30 years? The short answer is that there's no way to know. Most companies in history have ended up either going bankrupt or bought out by somebody else. Just think of this for a second. Remember Nokia and BlackBerry just a few years ago? There was no stopping them, and they sold millions of phones to people and almost every company in the world. Most people thought there was no way of stopping them, and surely they had to be the big players forever, right? Then along came Apple with the iPhone, and over just a few short years, Nokia and BlackBerry were left out in the dark. Take a look at the long-term chart showing the share price of all of the three different companies, and imagine being an investor in Nokia and BlackBerry holding on for dear life. In history, there are loads of examples like this, and they stand as a good reminder that there is no way to know the future. So therefore, we have to diversify. We have to make sure that we own lots of different stocks so we don't just lose all of our money in just a single one. Now, at this point, some people might say that you need to have 30 stocks, 10 stocks, or maybe even 100 different stocks, and they need to all fit in certain different categories or be from different industries. But the simple fact is that you don't need to pick stocks at all. The secret is that you can just own all of them, and in the long term, you'll probably beat most investors, even the professionals. This comes down to the simple fact that most companies don't actually do very well, and only a handful end up making all of the huge gains that you hear about here on YouTube or in the media. Remember the story about BlackBerry and Nokia from earlier? Well, this happens all the time, so rather than trying to pick the winners, there's a super simple way to own everything, and here's where an investor's best friend comes in. You guessed it, the index fund. To put this really simply, an index fund just buys all of the companies together, and the bigger the company, the more shares that the fund will buy. As the companies get bigger or smaller, an index fund automatically adjusts so you don't have to do anything about it. You might have already heard about popular index funds that follow the S&P 500 in the US or the FTSE 100 here in the UK. Both of these are types of indexes, and there are even global ones too, which I personally really like. They're cheap to invest in, you don't have to stress about which companies to pick, and in the very long term, they have done very well. For example, let me show you what a long-term investment might look like. Let's say you can put in £200 a month and you just invest it into an index fund. If you did this for 30 years, every single month without stopping, you'd have almost 200k in your investing account. Now that's a pretty good investment, easier said than done to make sure that you actually do it for 30 years, but still, the rewards are there for those people who really stick with this for the long term. Oh, and that was being fairly conservative by using 6% as an average rate, which allows for inflation along the way. Okay, so just invest in an index fund and that's the whole portfolio complete? Well, potentially yes, but let me just go through some of the other points because I think this is where things get a bit more interesting for some people. What about the other things we need to invest in like bonds, real estate, commodities, or even cryptocurrency? Well, let's just quickly address bonds. These are a much safer style of investment, but you typically get back a much lower rate of return. You can get bonds from governments or even companies, and the idea is simple. You buy a bond, and in return, you'll get a fixed amount of interest over a certain period of time. For example, right now, you can buy a bond from the UK government called the Gilt and get 4.6% a year if you buy a 2-year one. So a £1,000 investment would get you £46 a year, but you'd only get that paid at the end of the 2 years. So in total, you'd get £92 plus your original £1,000 back in 2 years' time. Now, clearly, compared to the long-term average of the stock market, a bond doesn't look like a good investment. But there have been times in the past when actually bonds have performed really well. This is why, in the past at least, lots of people have mixed stocks and bonds to create their investing portfolios. And there's even a famous portfolio called the 60-40, which is 60% stocks and 40% bonds. The general rule that you'll come across says that the older you get, the greater percentage of bonds that you might want to have, as this helps protect your investments from those big stock market crashes. However, this really is a personal decision and will all depend on your own circumstances. Remember, I'm not a financial advisor, so we really need to find out what works for you. And this is all just my own opinion and my own thoughts about investing. Now, what about all of the rest of the things that we can invest in? There's so many more things to choose from. What are we going to put in this investing portfolio to make it the best it can possibly be? Are we going to add in some gold, property and cryptocurrency as well? And then we have to ask the same question as before. How much do we put into each one? Because we don't want to get this part wrong, right? You can see how this can start to get very complicated, that you end up just not bothering, or you end up paying someone else loads of money to do it for you. Because in all honesty, there is no simple right answer here. The answer always ends up as it depends on you. For me personally, I like to keep things a lot simpler, but with one big caveat. So for anything like commodities, oil, lumber, real estate, or even gold and silver, I don't see a need to add these into a portfolio separately. And the reason is that with something like a global index fund, you get all of that already included. Think of it like this, for example. Inside an index fund, you will own all of the biggest oil companies in the world, and their value might rise and fall depending a lot on the value of oil. I personally don't see any need to own oil directly, even though you can actually do that using some different types of investments. It's the same when it comes to property and real estate investment trusts. If you own a global index fund or even something like the S&P 500, you will get lots of REITs and lots of commercial property companies. In fact, just like the oil companies, you will get the biggest ones in the world, all organised by their size. And what more do you really need? If you end up picking and choosing additional property companies, all you end up doing is just making a bet on the future. And remember what we learned earlier? Just think BlackBerry and Nokia. The next Apple is always lurking around the corner to take your lunch money and ruin your investment returns. Now, just on the big caveat that I mentioned earlier, the longer you invest for, at least in my experience, you realise just how important it is to manage your emotions, but also just how much psychology plays in the whole investing market. As much as it's solid advice to just say, buy a global index fund, invest every month and never look at your account, that just doesn't really work for most people because, well, we're human. It's like saying, eat healthily, consume less calories than you burn, and you'll lose weight. Most people already know this, yet there will always be some kind of new fad diet promising to fix problems for you some other way. So my caveat for investing, which is slightly different to what I believed in when I started, is that you have to create a portfolio that works for you. And all I mean by this is something that even if it looks a bit weird to someone else, as long as you can stick with it, that's way more important than trying to do something that you don't want to do. So, for example, if you're really interested and love picking stocks, then pick some stocks. Don't force yourself to invest in an index fund and never look at your account again if you know that you won't stick with it or start lying to yourself. For me, my portfolio looks something like this if I break it all down. It's about 65% in index funds, 20% in individual stocks, 10% in some private equity of a company I used to work for, and about 5% is probably some Bitcoin. Will my individual stock picking probably not beat the market in the long run? Sure. So it's up to me to keep that side manageable and keep it reasonable to stop getting carried away. Has it grown a bit larger because it's had a really good year last year? Absolutely. And my stocks made about 5 times what my index funds did last year. Likewise, is investing in cryptocurrency risky? Yes, absolutely. But I'm happy to take a risk with a very small part of my portfolio. This all comes down to the fact that I enjoy the tinkering part a bit, and I know that I enjoy playing around a little bit while trying to keep my head screwed on, at least most of the time. For you, this might look completely different, and you might not be interested in stocks at all, so one fund could be all you need. Or you could be getting closer to retirement and have a much lower appetite for risk than someone like me in their mid-30s. Now that's a reminder I'm getting old. So you might keep more cash or even some bonds. It really is up to you. But if you don't stick with a plan over the long run, you'll never get any of the returns. It always sounds simple, but believe me, it's very difficult to stick when everything is crashing down around you. I do firmly believe that for most people who are in the stages of building wealth with many decades ahead of them, the majority of their investments should be in low-cost index funds. But after that, I also do believe that a smaller slice should be really up to you to play around with, if that's what you choose. I only say this after realising that we're human after all, and we do all kinds of other things that are stupid or irrational. You've only got to walk outside down your local high street for a few minutes to see that. If having a small slice of your portfolio in a risky stock prevents you from going all in on one investment because someone on YouTube told you it was going to the moon, then that's got to be a good thing, right? So find out what works for you, stick with it for the long run, and don't just let that small crazy slice of your portfolio get too big. But hey, that's just my view. Now, one final thing to say that I probably should have mentioned earlier is that whatever you do, please make sure that you use your tax-protected investing accounts. So for us here in the UK, that'll be your ISA accounts like the Stocks and Shares ISA, or even something like your workplace pension or self-invested personal pension. I'm not going to go into the details here as I've made loads of videos about them on my channel. Now, I will say as a reminder that if you do want to get started investing, I keep the links to all of the platforms that I use in the description below. Some will get you some free cash or free shares to help you get started, and they can also help support the channel so I can keep making useful videos like this, or at least I hope it was useful. And on that note, let me know what you think in the comment section below, and until next time, happy investing.